Good evening, everybody. We're going to do a quick session on bull spreads. And the reason we're just sticking to one topic when we do the spreads, and there's different strategies, which we will do all together sometime. We had the bull call spreads, or whether it's better to sell put spreads as credit spreads. And so we'll kind of keep those separate just because some people have to have it clearly illustrated how a bull spread works, and then how selling a put spread works, and that takes a completely U-turn as far as thinking. So we'll kind of keep them separate. But a lot of people have been asking, they say, well, we're going to don't want to do a spread because that's so difficult. And it's actually very easy. So I'm going to start right from the basics. Essentially, a bull spread is very useful when your upside potential for the move makes buying the calls alone too expensive for getting in and heading for the potential target. Or sometimes, let's see, the other side of it is, I don't know where that screen went. Is sometimes the call by itself is, hello Red Bush, way from Germany. Sometimes buying the call itself is just too expensive. Yes, and there's the next screen, DJ, is when you put on a spread, you have less market or money exposed to market risk. The percent return is greatly enhanced, even at a lower target price. And then the break even is much lower. So the important factor that we attribute or contribute to candlestick analysis in option trading is, does the math make sense? Now, we've got advantages with candlestick analysis. Obviously, we've got chart setups that show us where with a high degree of probability which direction the market or the direction is moving. The timeliness of the move, so we know exactly when we should be putting on a trade. And then we can calculate at times what the magnitude of the move is based upon the candlestick pattern setup. I've got different criteria for myself. Now, this doesn't apply to everybody, but this is just kind of a general rule of thumb for me. If I like a price move, but my only option to buy is 4 weeks or longer, I'll buy the straight out calls or puts, depending on which way we're going. PIT, yes, they also limit your upside potential. However, you've got to calculate using, or especially you can calculate using candlestick analysis of what your probabilities are. And I'll kind of demonstrate that your probabilities are that a price, I would say most of the prices that you get into are not going to skyrocket and make huge profits on the calls. A lot of prices you get into will move up nicely, may not be huge moves. So you've got a much greater advantage by being in the spread versus buying the calls outright. You can always close out the spread and do another one, yes. Yes, and your risk, this is all adding up, and we'll get to that. The risk reward. Now, the reason I only do spreads out 2 or 3 weeks, because there is a disadvantage of putting on a spread too far out in front of expiration. And that is, if the price does move excessively in the direction you want it to, your spread price might go down versus up, because it's still the difference between the two strike prices, that one you bought and one you sold. If you're way out in front, those strike prices can move around anywhere, and I'll give an example of that. Then, if I'm doing a credit spread, it's usually very short term, that final week. So, just to kind of go backwards, what is a spread? A spread is basically buying and selling an equal number of options of the same class, of the same underlying security, but at different strike prices. So, for example, for example, let's say we are looking at a stock that's trading at 50, and we think the target price is 55 over or before expiration. Well, if we buy those, let's say hypothetically, those 50 calls are trading for $2.50, and they go to our $55 strike price. Well, obviously your $2.50 has now gone to $5, where you've made a $2.50 profit for 100% gain. But where's your break even? Your break even is it has to go up to at least $52.50 just to get your $52.50 back. So that's the normal structure of buying the calls. Now, if we decide to go with a spread, and stock's trading at 50, our target is 55. If we buy the 50s for $2.50, and let's say we sell the 55s for $1, that means we've put $1.50 in our pocket. If it hits our target price, now our $1.50 is gone to $5, or we've made $3.50 profit, which now turns into, I think that's a 275% return. And our break even, why did I do it? Our break even is only $1 or $51.50. So that's pretty a pretty good percentage difference. So our relevant decisions are how much time do we have to expiration and what strike price and or the combination. Now we'll go back to we'll go back to who DJs who mentioned that it limits your again, saying it reduces your rewards. It reduces your rewards and limits your profits only if the price moves in a big manner. I think I've got that explained. But let's put it this way. If we do a spread that has to go from 50 to 55, and it makes a 275% profit, if to do the same return, and I thought I had these, to do the same return on just buying the calls outright, I don't know the exact math, but it would probably be in the realm that to make the same percent return, the price in just buying the calls outright, the price would have to go to maybe $62 to make the same 100 or 275% return. Yes. Yeah, the net cost on the spread is $1.50. What did I say it wrong? Yeah, if I bought the December 50s for $2.50 and I sold the 55s for $1, my net cost would be $1.50. What is your normal risk cost? Oh, what does that mean? What is your normal risk cost for a? I don't know what that means, Don. Normal at-risk cost. Oh, did I say that wrong? Yes, that would be out of pocket. All right, thank you, Alan. That you would have to go to make the same return on for that spread. If you just bought the calls outright, Alan has done the math for me. It would have to go to $59.40 to make the same return. Plus, your break even would have still been, whoops, where was it? Up. Instead of your break even being $51.50, would have to go to $52.50. So the advantages, again, is you get better leverage, you get less market risk, your break even is lower, and it doesn't have to move nearly as much to get a good percent return. I use, my criteria, if I'm going to be looking at a $5 spread, I don't want to pay any more than $2. So, yeah, how much would I pay for a $5 spread? I don't want to pay any more than $2. Now, people are going to say, well, if you pay $2.50, isn't 100% profit on a spread good? Yes, but you always have to remember what your risk-reward factor is. First of all, you still have to be right in the price move. Second of all, you still have to be right in the magnitude of the move. And that means that if you try to do it on a 50-50 basis, you're probably going to come out behind in the long run. So for that extra risk factor, I just use a rule of thumb that if I'm going to buy an option spread that's going to maximize at $5, I'm going to not spend any more than $2. Obviously, a $10 spread, not anything more than $4. Okay, so Bill, that's up above my limit because of the risk-reward factors. Yes, now, remember, oops, what did Kathy say? Yes, Kathy, this is all related to how you put on an option trade based upon your analysis of a candlestick signal. We'll get to that here in a minute. Yeah, so option trading is also a method of buying the stock. So there's going to be people that trade the stock, or they want to buy the options, all depending on the nature of each individual. Yes, the parameters of staying in the trade is not any different than the parameters of just buying the stock outright. So if you're making a decision to buy a stock because it's a buy signal and it's trading above the T line, and instead of buying the stock, buying the option is just a method for buying that stock, you use the same parameters as far as analyzing when to come back out of that trade. If you bought the 50 call, you'd need to get to the 59.3750 to get there, to get that return. So at that point, you'd be better if you sold the 60 instead of the 55? Well, you don't know that. I mean, now you're taking a number that would have to be the result of buying that spread and extrapolating that if you didn't buy the spread, that's where the stock price had to go. So now you're saying, well, if that's where the stock price had to go, you'd be better off selling the 60. No, you're deciding if that stock is going to go from 50 to 55, what is the best method to take advantage of that price move? How do you determine the target of the upper part of the spread? That's based upon analyzing the chart and seeing what your target is. We'll get to that here in a minute. Yes, so $3 profit on a $2 cost is 150%. Would you target 33% of spread for maximum paid? Dan, I don't know what that means. You would not target 33% of spread for max paid? I don't understand that. So does that mean the bought call is usually, yes, it's usually out of the money. Or the sold call, they can both be out of the money. And that's each individual's risk reward. Okay, all right. So this is why we do spread trainings, is because of the number of questions we get when we do this. So when selling the 55, do I need to have 5,500 in my account? No. You're buying the 50 for whatever price we said. And then you're selling the 55. So you're already secured by the fact that you're buying the 50. So you don't need to have 5,500 in your account. You need to have $150 in your account, because the worst case scenario on that trade is you're going to lose 150 or $1.50 if the price doesn't move at all, or the price goes down and you don't sell it before it gets to expiration. I'm reading and forgetting what I just said. So no, you don't need to have that margin. Pay 33 cents for a dollar spread. Well, now we're paying, I mean, that can be up to your, whatever you feel comfortable with. I'll pay 40 cents for a dollar spread. If stock moves up $5, how much option price will move? What factors? It depends. Is there a chart for option? No, if the price moves up, the closer you get to expiration, the wider that spread's going to occur, because each option price is going to get closer to its strike price value versus having any time premium built into it. Okay, let me go through this a little bit more. I'll keep answering questions before we go on to live charts. My frequent question is, when candlesticks show a breakout or a best friend or a kicker or a McMuffin, how long do you go out for? And then you decide the option style based on how long out you go, correct? Yes, that'll be a function of seeing what type of pattern you have. Okay, here we go. So let me go through this. That's right. I'm going to review it as the show goes on. Delta has nothing to do with candlesticks, because the previous delta, let me go on and I'll answer those. If options are expensive due to implied volatility above 0.7, it's better to sell the option rather than buy it. That's based upon, has nothing to do with what the underlying stock price is going to do. Okay, here we go. So here are the important factors. How much time do we have to expiration, and what stock or what strike price? So if I see this pattern, kind of a fry pan bottom J hook, how long do I expect it to move in this direction? How far will it go based on this in 2 weeks, 4 weeks? And you can kind of visually anticipate that. So now you go back and say, what's the math for this? Now we have an advantage with the J hook pattern. For example, we know that wave 1 and wave 3 are going to be the same. So if we can calculate how long wave 1 occurred, and that maybe wave 3 will be a little bit faster after the J hook, that if we're buying calls in here, or we can decide whether we want to do calls or maybe a combination of buying the calls and buying a spread, buying this level and selling this level. So you've got a lot of opportunities, or a lot of different oh, Jim, did you do that? Yeah, let the chat go on. I can talk through that. So if I'm buying calls right here, I might add a spread up here, or get real fancy and do a spread up here. So again, I want to have my rate of return be somewhere, should be 1.5 to 2 times greater. But again, if I'm buying a spread for $2, I want it to go to $5. So here is the math risk reward. If we know the pattern, such as a fry pan bottom breakout, again, we might decide to buy some calls here and maybe a spread up here. And as it goes up, we can do another spread up here. Because we can calculate what we would expect coming out of a fry pan bottom. What do we expect coming out of a fry pan bottom? A very strong price move. If we have the timing, if we see a J hook pattern setting up, we know exactly where the breakout is, that we can start buying at that, or buying calls, or a call strategy, meaning buying the calls and or saying, all right, it's broken out, I'm going to do a spread up here. So we have the price move expectation based upon analyzing what different patterns. So here was an example that we used as far as the math. We could see that Amazon, this was a while back, was trading around the 1700. So we could be buying the calls for $9.30. And what was our first anticipated target? Up here to 200, which was at 1730. So that meant our calls that we bought at 930 would have the potential of going to $30. Now, if we used a spread, what was the risk reward? Again, if we bought the calls and it went to $20.70 profit, or 22% return. But it also showed at the time that if we bought the 1700s and we sold the 1710s for $1.80, you can't see the slide. Is anybody else having that problem? Acadia, are you up at the very top of your screen? Make sure that you're clicked on screen sharing. So this was a much easier trade analysis. That if we bought the 1700s and sold the 1710s, it was actually $1.80, which now told us that if we just went to, did I say that right? We bought the 1710s for $1.80. That told us that if we went to, all we had to do was go to 1710 to make a tremendous profit. So what did that tell us? That told us that to make that same percent return, I forget what the numbers were, but the price, instead of having to go to 1730, would have had to gone to 1751. Yeah, so to make that same percentage return, it would have to have gone up here versus here. Plus, look at the risk reward. Now, you can make your decision based upon how far out do you want to go. Now, something like, this was Foot Locker. You can do the monthly calls or the weeklies. Now, the disadvantage to doing the weeklies is the open interest, the volume. But you can go, and if they've got good volume, you can see if it's more advantageous that instead of not buying a, let's say this was, that's not right. Let's say if you wanted to go out to the June, 38 days out may be too long for a spread. Whereas if the price move looks good, you might be looking at something that may be 2 weeks out. So again, with a spread, you've got less money exposed to market risk. Your percent return is greatly enhanced and doesn't have to go to a, it can go to a much lower target to make a very good return. And again, your break even is much lower. Now, there are times when, is there an advantage to sell puts instead of buying calls on a strong signal? Not necessarily on a strong signal. If you think that your price move is going to go up, but the market doesn't look great, and your target isn't that far away, it may not make sense to buy a bullish spread because that price has to go up, still continue up, get above a certain level to break even, and then get to your target. Well, if that seems a little bit iffy, now you can say, all right, what if I sell a put spread? Now remember, selling a put spread is bullish. It's not buying a put spread. It's selling a put spread, which means that is a credit spread. You're putting money in your pocket. And it usually means the price doesn't have to go up very much to keep all that money in your pocket. As a matter of fact, there's some credit spreads where the price could even go down a little bit from where you put on the trade and still keep all that money. But that's why I don't want to go into that very much in this session, Larry, because that changes. I mean, that's a completely different mindset, but that's something we will do soon where we we'll do a credit spread session, and then we'll combine the two later on to show where the advantages are for which ones we want to put on. So if the options are too expensive, like today, if we were looking at options and we think Amazon might have a strong move, why is there a disadvantage with weekly options? Because the open interest is usually a lot smaller. I'll show that here in a second. So if we thought Amazon was going to have a big price move, we might not be able to afford an 80, $70, $75, $73 option price. And that's for one contract, you're looking at big bucks. So what's the other alternative? Well, if you think it's going to be a big move, maybe you go out and you buy the 32.10 and sell the 32.20 for $3.30 net out of pocket. Now if it moves big, this has the potential of moving to 10 bucks. You could participate in that big price move if that's what you think was happening, but you could do it at a much more reasonable price. And why is the time to expiration important? Again, if you get too far out in front, you could be sitting at in a spread that is actually going down even though the price of the trade of the stock is going higher. Would a stock that is trading sideways be appropriate for a bull put spread? Jojo, the reason I can't answer that clearly is because the whole point of candlestick analysis is to analyze which ones are having strong price moves. If you see a stock that's having a non-price move, yes, there's things that you can put on, like what they call collars or straddles or strangles. But that's a different, that's going away from the whole point of using candlestick analysis in the first place. Do you take things like implied volatility into account? No. No, because what we're anticipating is that when you see a new price setup, that this price move or the delta or gamma or whatever you want to put on this is not going to be the same for the expected price move that comes out of a candlestick pattern. This session is recorded, yes. So this was a good place. We bought the calls. Made very good money up here, but we still didn't have a sell signal. Still had a up day. We took profits, put a lot of money back in the account, but we didn't know whether this trend was over or not. Unfortunately, the only calls that were available were the August calls, and they were about 5 weeks out. But I went ahead and did it anyways, once again to my detriment, because I bought the 22.50 25 calls for $1. Because what would be the risk reward? If it stayed above $25, that dollar would now go to $2.50. That's a decent rate of return. And my risk reward at this point was I'm already up in the overbought area. It's already had a good move. Put lots of money in my pocket. Now, if it just stays above the $25 level, I'm still going to make good money. However, I made two mistakes. One, I bought a spread 5 weeks out in front of expiration. Maybe even 6 weeks out in front of expiration. And I didn't check to see what the open interest was. If the expiration is further out, would it be more advantageous to go deeper in the money? Not really. You're in the your rate of return is probably not going to be as great. And the whole point of putting on the spread is to take advantage of a price move. And so why put on a spread that is longer or much further out? The whole point of a spread is to take advantage of what would be a little bit better price move. Well, you're not worried about time decay, because probably the time decay is already built into or taken out of your deeper in the money. So you're probably paying a higher price for it. You broke one of your rules, yes. This is one of those things where you do as I say, not as I do. So I put on the spread anyways, just for the ego factor that, boy, if this is still going higher, I can still make more money. I'd be clever. However, you can see what it did. I think it actually went up here to, very quickly, up to the $35 level, way above the $25 level. Well, you'd think that the calls would probably have gotten up to where it was getting closer to 250 because it was way up above that level, but it wasn't. It was still trading at 80 cents, or sometimes it'd go to $1.05, sometimes $1.30. So I was stuck in it. I couldn't get out of it for two reasons. Well, I guess the main reason was the open interest was not good enough to get me back out of those trades. So I could put in a sell factor. There was a day where they were trading at $2.40. And I'm thinking, oh boy, I've done it right. So I put my sell signal in, or put my sell in at 240. And it never executed because the next move was at $1.60. Then the next, because the price of the options had nothing to do with what the price was doing at the time. They were trading on their own merits that far out in front. How much open interest is considered too low? We'll get to that. We'll hold on for a second. So the assumption when you enter the spread is that there is a move in the very near future. Sounds like you're assuming that you don't actually sell the options back, but let things go to expiration. No, still looking for, again, or the point where one day they were trading at 240, but it popped up there real quick. Now remember, when you put on a spread, that means the brokers, whoever brokerage firm you're working with, have to go and make sure they can buy and sell both sides at the same time for the difference that you just put in, that price of the difference. So when I put it in at 240, well, they couldn't get it done because obviously there wasn't enough volume being done at that level. And two, the next price move based upon one of those prices moving took it back down to $1.60. So being stuck in a spread too far out in front, I'm taking a long time to explain this, was that as long as it stayed above $25, I'd have to hold it pretty much close to going to expiration to have to move in the right direction. Well, from there, my risk was if I can't get out of it, in the last couple of days, I don't know, yeah, we got it on live charts, it moved from 35 all the way back to 23. As a matter of fact, I think it went as low as 21.70. So not only did it go back below the 25, it went back below the 22.50, which meant that spread that could have been, should have been going to 250 was now going back to zero. Okay, so anyways, that's the disadvantage. So open interest becomes a viable factor. Now, let's see, who was this? I think this was on, this was on, oops, I goofed. So look at where the open interest is. There's the volume or the open interest at the 30s. There's the open interest at 35s. But look at the prices in between the round numbers. Much lower. So if I happen to have picked out a spread that looked real good, let's say the 31s and the 33s, that might look attractive except for the fact that there's so little volume that I might be stuck in that one. So the reason you don't want to get stuck is just like any other trade setup. You don't want to be caught where you're stuck in a trade. You can't get out of it when you want your money to go on and do something else. Do you have some sort of stop loss in it? If that's the problem, that's what I was illustrating, Jake, on that situation, was it didn't matter what my stop loss was. I still couldn't get out of that trade because there wasn't, I was still stuck in it. And now, I'm the type that doesn't like to make the same mistake 7 times. I did the same thing, I think it was on LVGO, where I put the spreads on, and the stock was trading well above my upper strike price, and that should have meant that it should have been worth $5, but it was still trading at $3.20, right up into expiration. And so when I called the traders, again, the open interest was so low that they just couldn't get it done. So what we had to do on expiration day was I exercised the ones that I'd bought, and obviously somebody exercised the ones that I had sold. So we just crossed the stock, and that's where I got the $5. So I had to hold on to that trade that whole time, going right to expiration, and then not even closing out the option trade. I had to execute both sides of the trade. You could exercise them separately. However, what that does, and I don't know what the calculation is, if I exercised or closed out the long side, so now I'm just short, now that might change the margin requirements. You didn't need to, Jay, because when you exercised it, you were getting the stock from somebody that you had, well, the ones that you had bought, and then somebody was going to exercise the stock that you sold. So it's just a cross transaction. You don't have to have you have the stock to hand over to the people that were calling it from you, because you'd gotten it from somebody else. Okay. All right. Let me, I think I only got a few more slides. So here's what we're looking at tomorrow. Look at our McMuffin on UPWK. Morningstar signal followed by a Doji Sandwich, expected upside. Where's our first target? Up here. Well, going up toward the $17 area, the calls might not make to do it. So maybe you do a 15, buy the 15s and sell the 1750s for 70 cents to have that go to $2.50. Besides open interest, you to consider weekly trading volume on the option. Oh yeah, that's going to be a function of your open interest. The volume is going to be a direct function of how much is being traded out there. I have a bull call on Adobe and cannot get out. What do you mean you can't get out? You should be able to get out of a call if you're just one-sided. It's the spread that they have to go and make sure that they can buy and sell those two sides for you and have the difference. All right, let me finish up, then we'll take up all the questions. Again, less money exposed to market risk. The percent return is greatly enhanced, even at hitting a much lower target, and your break even is lower. I would guesstimate that 80% of my trades are spreads, provided you can get in and out of them easily. So these are the decision making that you have to do to put on a trade. Remember, you're putting on the trade to make money, which is obviously stated. But, and the first assumption is that you're analyzing a stock price move that you think is going to move in the right direction to produce a good return. And if it's better putting on the spread, then you have to make sure that you can get in that spread and get out of it easily when you want to come out. So if I'm looking at a spread and I see one side has open interest of 830 positions, and the other side only has 64 open positions, that means if I put on a spread, I might not be able to come out of it because there might be nobody ready to trade at a price on that 64 option open interest side. You could always lower your order price, but that still doesn't help you if the volume is so low that no matter what price you put in, there's not enough trading on one side or the other to help you get out of that position. Oh, the spread. Okay, on Adobe. Now that's surprising because I would have thought that Adobe would have had lots of volume. DD, if I'm putting on a spread, that's my trade. If I decide that it's running stronger, I'll keep the spread on, and then I'll buy calls in addition to the spread. But the whole point of figuring out what the trade is making your calculation going into that trade. If it changes, it's not changing the strategy that you put on, but it may change your positioning, meaning if I bought a spread with it expecting it to go to a certain price level and it's showing a lot stronger, then maybe I come back and buy more calls on the long side. Okay. I was thinking that it may be easier to get out of the short than the long. Yeah, you get it. Still is kind of a function of, is there volume going on where when you can get out of the long, can you get out of the short at a good price? So it's a two-step function where both of them have to be occurring to get your price. The open interest usually, Joseph, yes, is better in the monthly calls or options. Probably. I was just kind of using that as an example that, yeah, the closest options, and that's another thing, too, that you look to see whether you can buy a weekly or buy something. So if you're buying something that's 2 weeks out and it happens to be a weekly, then you better check to see that the open interest on that weekly is good enough to get in and out. So that is why the volume on the underlying stock is very relevant to the amount of options that are or the open interest on the options. Again, when you unload one side, now you're changing your strategy. Now, just because the stock price goes down a little bit, that doesn't necessarily mean that your spread price goes down, because both of those options are probably going down. It's a function now of at what speed does one go further than the other or faster than the other? How do you determine what is healthy open interest? What's the minimum number? That's if I see something that has open interest, maybe of 300, and if let's say I'm going to do two spreads or two spreads, I want to make sure that both sides are maybe 200 to 300 or more. So again, that open interest is still going to be a function of how much volume trades in the underlying stock. So stocks that trade at $45 and trade 600,000 shares a day, that's not difficult if you're putting on a stock position to get in and out of. But the options may be a little bit light. Might not be light for buying the calls on one side or buying the calls, but it might be a little bit light if you're trying to match the two, both buying and selling the different strike prices. Okay. Yeah, no, probably even 100 per spread or higher. Yeah, probably at least. Yeah, even 100 is probably too light. Still probably want. Remember, you're waiting to get in and out of a position where both sides are trading relatively liquid, so that the person or the trader that is working on closing that position for you isn't sitting there just watching where there's some trades on the buy side option, but there's no trades going on the sell side, and then 40 minutes later there's some trades going on the sell side option, but no trades going on the buy side. They just won't be able to get it done. Oh, on the thinner side, yeah, I would make 100 at least a minimum. Much harder to get good fills, so I have to move to open interest requirement J here. So that's, again, the whole basis of putting on a spread is to make money. And if the playing field isn't allowing you to make money, you've got to go to a playing field that you can get it out. Okay. Oh, Becky, was there yeah, we're going to be doing, this is the type of thing that I try to kind of illustrate over in the options room. Becky, do you want to put in the, there you go. We're doing, people want to try the options room for 90 days. We've got a quarterly membership being set up to try it. And again, the options room is basically identifying the stock moves that you would identify over in the regular room, but then going through which option strategies make the most sense for that option move. Yeah, I'd probably still be up around 300 contracts or greater on both sides. Okay, let's go to some live charts because we had an interesting day. Is it better to let the... No, they aren't negotiating for you. They're taking orders for you. Yeah, so if I can do this real quick. It's very simple on... you can see how this is Think or Swim. And I don't know whether I'm going to do this real quick just to show you how easy this is. I want to delete this. So here is your, oops, you can see over here, here's what your calls are. But if you decide that you want to do a spread, you just come over here and you right click, you buy, and over here on this column you go up to vertical, which is up here at the very top, and that brings up this. which is showing you if you're buying the 15s and selling the 1750s, you're going to pay 70 cents. If you decide you want to check around and say, well, what if I want to buy the 1250s and sell the 1750s, 220? And again, that's a little bit out of my my range. So you can go up and down the scale and see which ones make the most sense. Then once you see which ones make the most sense, then you can check to see what the open interest. Now over here it's showing that there's 1,000 or plus in each one, so the liquidity on this one would be pretty easy. Okay, let's go to live charts. We saw what happened today, where the knee-jerk reaction on the economy, down 32%. They took it right down, hit the 50, and came back up on the Dow. Open is high, but trade. Yeah, I just was using this one as a calculator or as a illustration on UPWK. All right, so we saw that they took the market down, but look where they closed it, a hammer signal. We saw what happened over here on the NASDAQ. Let's make this a little bit smaller. They actually closed it positive. So with that analysis, what's it telling us about the market conditions? Well, if they're taking the NASDAQ up and the Dow is doing a hammer and the S&P traded back up above the T-line, and the transportation index was trading, above the T-line. What's our assessment? The bullish sentiment is still, may not be wildly exciting, but that doesn't matter to us as candlestick investors, because as long as the market's not selling off, we're going to find tons of good chart patterns setting up or in progress. Yes, and right now the pre-market futures are up, should be up pretty strong, because Apple beat earnings, Amazon beat earnings, Facebook beat earnings. I forget who else out there, but let's take a gander at what patterns are working. Remember last week, Sogu was doing the best friend gap up, fry pan bottom, bam. This week, we got into Blink, which was your fry pan bottom setup. We were actually buying in here because of the fry pan bottom setting up. Had a good day here and then another good day. So these are the type of things where when the breakout occurs, you're expecting good, strong price moves. Google beat also, that's right. So we recommended this one today. It didn't execute, but you can see the pattern. There's your J-hook pattern. Set up off the T-line up through the 50. If this opens positive, what do you got going on? Wave 3. We were recommending CEQP. It didn't execute today, but we can see what's setting up. There's your J-hook pattern. If this comes up through this level, you can still be buying it, because the gas utilities seem to be working well right now. EQT, another one that's done a J-hook pattern. If it comes up through this level, you're in wave 3. Oh, Ford beat. Yes, it was trading back up here when I saw it earlier, which means it's doing kind of a scoop pattern. So Overstock reported yesterday, and so this is observe the obvious. This uptrend's been good because it's never closed below the T-line. 4-for-1 split usually is good for a while, which is what Apple did? The one before was CEQP, which is another gas utility, that if this opens positive, bouncing off the 50, where do you think your next likely target could be? Up here. Yes, but remember, we're not buying stochastics. We're using stochastics to tell us where we are. Now, this uptrend tells us, all right, this could be exuberance at the top, but it was off earnings. So what do we want to see here? We want to see that it's still moving up in a 45 degrees. So where would be a very logical place to put your stop? Probably right here at the open. The moving averages are, the red one is the 200 simple moving average. The blue is the 50-day simple moving average. Every money manager in the world uses those to make their decisions. The 34 EMA works relatively effectively, and I say relatively, good enough that we want it on our charts. Here's the most important one. The 8 exponential moving average. If you combine the 8 exponential moving average, which acts like a Fibonacci characteristic, it's where it acts like a natural support and resistance level of human nature. And if you combine that with the aspect that candlestick signals are the graphic depiction of investor sentiment, and you combine it with a natural support and resistance level of human nature, when you combine those two, you've got one of the most powerful combinations for correct trade ratios that you're going to come across. And that's just me saying it because I've used every single technical indicator you can think of through the last 40 years, and this combination is the strongest of all of them. Do you worry about limited partnerships and K1s for trading? No. That's accounting. That's not trading concerns. Oh, what we're looking for, Suraj, is stocks that are doing patterns that are still trading above the T-line. Look at your little J-hook pattern right here. Told us we were going to have more upside. Stochastics were up here in the overbought area. So remember, the first criteria for candlestick analysis is the signals and patterns themselves. Then the T-line is a confirming indicator, and the stochastics. Obviously, you're not buying a candlestick buy signal when you're in the overbought area. And you're not selling a candlestick sell signal in the oversold area. The stochastics, my stochastics are 1233. Yep, Jim has it right there in the pink for you. RP both. Depending on what we think is the best, or a combination of both. $409 on Apple, yes. The 3 EMA has two functions. The further away you get from the T-line, the more effective the 3 T-line becomes. Also, if you're trading above the 3 T-line, that tells you there's still a lot of force in there that you're not even coming back down to the T-line. Secondly, let's see, it might be on here, but if you see a buy signal or if you see a pullback and the 3T line doesn't get down through the T line, kind of assume that maybe the downtrend's not over. See if what happens on the next signal. So it just acts as an additional confirmation of your price trend. All right, let's go through. Here's the one that I couldn't get out of, but look at what happened today. A bullish engulfing in the oversold area. Get ready to buy this one. There's your J-hook pattern setup. As a matter of fact, I think this one was trading up at $28 after hours. Net was one that somebody pointed out today in the chat room. Bert did. Let's see, Bert is in here. Hold on to your individual requests until I tell Jim to do the double line, and then because we're going to be behind schedule tonight, just limit yourself to one request. The stochastics are slow stochastics. Yes, so the moving averages, the reason the moving averages are on here, we don't use them to make our decisions. We're using them to see what everybody else is doing because of the graphics. It tells us exactly what decisions they're making at the moving averages. So net was a bullish flutter kicker. Whenever we see this doji gap up at the previous day's open, that's already got the gap up built into it. Now we have the doji rule. It's going to move in the direction of how they trade after a doji, which tells us that if they took out the little doji, the flutter, we have a kicker signal, which is your strongest signal. That was also evident in Chegg. Gapped up yesterday above the previous day's open and was trading positive. So it gapped up, went positive today. So now what do we have? A bullish flutter kicker, and we're right at a breakout level. You definitely can be buying this one on positive trading tomorrow. All right, just a few that we've got positions on right now. Rollins, same scenario. There's your J-hook pattern, and what kept us in this. Look at this. This one traded above the 3T line, came right back to the T line and went positive again. This tells us we're in an uptrend. We got into the housing stocks. Toll Brothers. Let me make this smaller. We can see we're right at a breakout level. Whoops, make it smaller yet. Nope, smaller. And then it did a J-hook pattern, bobble breakout. So what's our criteria? We just stay long as it doesn't close below the T line. Sienna, another one that broke out with a gap up through this level after your Morningstar signal off the 50. There's your doji sandwich, and then it broke out. You just stay long and see how this one has been staying above the T line. Let me go through these real quick. There's your 45-degree potential. If this opens positive, we're still heading in that 45-degree. On something like Rollins, where you don't really have a target, do you do a spread or just buy an option outright? On Rollins, back here, you at least had a target. If this is wave 1, wave 3 was probably up here somewhere. You could have done a spread on that one. Right now, wouldn't do anything except hold, so wouldn't be buying anything up here. Dix was also a strong signal. Notice where our breakout was. You can see the resistance level. And then there's our best friend signal breaking out. This is wave 1. How long do we hold on to this? As long as wave 3 stays above not only the 3T line, but the T line. Yeah, ecom looks like a little wedge type setup. So now we know exactly what it will likely do because of the doji. Simple doji rule. It's going to move in the direction of how they open after a doji. So here's sample or simple. We bought this because there was our bobble breakout. Bobble is a more defined J-hook pattern. If you took the 200 out, you essentially have a J-hook pattern. Now, where do we sell? Well, if you didn't close it out today, you've only got one rule to follow, the doji rule. It has to open positive and trade positive to stay long. If it opens lower, you close out the position. We closed out our gold stocks over the last few days. Why? Because look where most people buy. They buy exuberantly at the top. We had a sell stop set right here at that low. Because logic says if it came down through there, it's coming back to the T-line. Why was that warning that much more apparent? Because they gapped it up in the overbought condition. Same thing on Harmony. Gapped it up, came back down, kind of did a bearish doji sandwich. This one we closed out on this day with the lower open because where was the next likely target? Down here to the T-line. What was the worst case scenario? We could always buy it back if it did a J-hook. So that kept us out. If you didn't get out on that day, definitely we're out today with it closing back below the T-line. Everything that helps you with getting in and out of a trade is just pure common sense of what happens on the specific signals that you see. We did. Okay. So yesterday we were buying in the options room. We were buying UPS going into the close. Why? Because everybody always asks, well, do you buy going into earnings or do you hold going into earnings? And the answer is you wait to see what the candlestick chart is telling you. Because people in the know usually are either going to be buying or selling based upon what they expect the earnings to be. Now, if this had closed down here as kind of a shooting star, yeah, you wouldn't have paid any attention to it. But we were buying and then had the benefit of this happening. That also affected our spreads when we were buying. Look at your doji sandwich breakout on FedEx. You just stayed long on this one, and I had spreads that I didn't realize. I thought it was expiring next week, but it's expiring tomorrow. But got out of those spreads at a decent profit today. Is gold, which has probably been going up because of all the uncertainty, be something you might short now that that will be, yeah, as you can see, gold actually traded down. It didn't sell off. Oh, pshaw, I didn't want to do that. It didn't trade off hard, but it started trading lower. And gold on the different months did a long-legged doji within the last couple of days. Oh, we are on these charts. Okay. Well, let's see. Look at the long-legged dojis. Look at the tweezer top. Look at the bearish left-right combo. So it's not looking good. It was up a little bit. That might be up a little bit after hours. But it's starting to get a little bit toppy. I would think that any weakness is going to bring it back down toward the T-line. It's near an all-time high, yes, as far as closing at an all-time high. But again, look at your long-legged dojis, kind of your tweezer top up here. That's That's saying keep an eye on gold. You might want to start taking profits if you're long on signs of any weakness from here. Amazon. Didn't know what to do with this, but now it's trading up here. Apple was strong going into the close today, and now it's trading up here, which puts you right back into this trend channel. Tesla, just flat. Nothing there. Netflix, still nothing there. And Nvidia was showing a little bit of strength. So you can see, make this bigger, kind of your belt hold signal. You're back up above the T line, and you're just right here at the breakout levels. This one can still be bought with the expectation of wave 1, wave 2, going into wave 3. All right, Amazon up to 32.04. So it's still up, what, 30, 40 points? Okay, so here are some of the ones that are acting well. You can see AQST kind of supported here at the 50 and may start wave 3. What started wave 1? There's your McMuffin, Morningstar signal followed by a doji sandwich. Kind of the same scenario on this one. There's your McMuffin followed by a doji sandwich. Would suspect your next uptrend is maybe wave 1, wave 2, now going into wave 3. What is this? Oh, we did the bullish flutter kickers. Chegg had a bullish flutter kicker today. Opened here, closed down here, gapped up, and then the doji rule, it moved in the direction of how they opened that after doji. That's why we were buying net when we saw it doing that same thing pretty early today. And Neo. Yep, for some reason that had a better looking, yeah, that's not, but that's an inverted hammer, bullish confirmation. For some reason that should not be there. So here's INO. Notice it gapped up toward the top end of the range. If this opens positive tomorrow, the doji rule. Now you got a bullish flutter kicker that they bounced off the 50 and now coming back up through the T line. That implies at least upside first target to fill the gap and then possibly even further. Would you miss gap up today on Cuervo based upon trading below the T line yesterday? So the next NVIDIA, I'm going backwards here on the ones that we've done. NVIDIA. Yeah, if this came from 375 to 425, 50 points, yeah, could have another 50-point rally. Cuervo, yeah, you wouldn't have expected this one, but you're not trying to anticipate. You're trying to figure out what is the best strategy when you do have a signal. So there's your best friend signal. Expect a 45-degree. A bullish flutter kicker. A bullish flutter kicker is you have a dark candle. The next day they gap up above the previous day's open, but they do a doji type day. And we know the doji rule. The price is usually going to trade in the direction of how they open after a doji. In this case, they started trading at positive. So if you took out this little flutter, you essentially have a kicker signal, which is your yeah, I'm all done talking about spreads right now, DD. Again, the spreads are a strategy to use when you find a chart pattern or signal that you like, and that maybe your risk factor is mitigated a little bit by doing a spread versus buying calls outright. Oh, so did we get the water kicker? Now here's a left-right combo on FLDM. Look how it bounced right off the 34, closed back up above the T-line. If it opens positive, well, remember, the left-right combo is one of your strongest reversal signals. And the fact that it closed above the T-line is additional confirmation that maybe the bulls have taken control. If it opens positive, what's it telling you? It's telling you the T-line is not going to be acting as resistance. It's confirming your left-right combo, and it's telling you this wave is being breached. That becomes a very strong buy signal. Here's the message on EDSA, EDSA. Gapped up but traded lower. Now what do we watch for? We watch for the selling or the profit taking to stop. And when it does, what do? We can start buying, because what was the message? The message was they came into this with great enthusiasm today. They took profits. Now we're waiting to see when that profit taking ends. The 34 is an EMA. Usually about the same time frame as wave 1 on a wave 3. Okay, well. The actual probabilities, Joe, are already built in. I mean, the reason we're looking at them today is because the probabilities that the Japanese rice traders have illustrated for us over the last 400 years was the signals we're looking at. Now, there's 50 or 60 signals in the candlestick universe. We've narrowed them down, or I've narrowed them down over the last 40 years to the 12 major signals. And if you just learn the 12 major signals, those are the bricks and mortar of candlestick analysis. You don't have to use up your mental time and energy learning all 50 or 60. The 12 major signals are the ones that will occur 99% of the time. And if you see something, another signal, you're probably still going to use one of the ones, another major signal that's occurred someplace else. So the 12 major signals will provide you with not only the strongest trades, but more trades than you'll ever be able to handle, so that at the end of each day when you do your scanning, which should take you less than 20 minutes, if you don't know what you're doing to find the best trades for the next day, I forgot what I was going to say. Oh, that just with the 12 major signals, again, you're going to have more trades than you ever be able to handle. And at that point, on each day, you're going to have more trades than you're going to need, so you can go into the process of cultivating which ones are the best ones as far as all the parameters of which ones are the strongest trades. TLSA, not Tesla, but TLSA. This one's got a J-hook pattern that you can buy into this profit taking if it opens positive tomorrow. The reason we stress learning 4 or 5 different signals and patterns. Oh, this one. Oh, this is it. This is a 45 degree. When you see a breakout like this, look at our dojis breakout. There's your 45 degree. How long do you hold on to a 45 degree? Blair, we can do another one. I think we did a scanning class just for the members just about a week or a week and a half ago. So your 45 degree, you stay long as it stays above the T line. And there's a breakout. So what do you expect after all this indecisive trade in a breakout? A 45 degree. So that's where you try to figure out what is the best strategy. Buying the stock, if you like to buy stocks, or buying calls, or maybe a call spread. Same scenario. There's your best friend breakout. What do you expect from here? A 45 degree, maybe the same trajectory as this. What's the best strategy to put on that one? NVCR. There's your J-hook pattern gap up. Expect a 45 degree off of here. If I was buying on positive trading, where's the logical place to put your stop? Right here at the open. If they came back down through there, they're resisting at the 200. After a breakout, far away from the T-line, how do we assess if the 45 degree will follow a reversal? For reversal, you pick a reversal spot. What do you want to see on a 45 degree? That it trades positive and then continues positive. Remember, the T-line is a function of the price, so the T-line will come up pretty quick to give you that support. And VKTX, big morning star signal. And your best friend on this side, that one you expect a 45 degree. J-hook patterns are also working very effectively. There's Acre. Breakout, pull back. Now observe the obvious. This is why the T-line is so effective when you're using candlestick signals. Look what happened when they pulled back. Now, the relevancy of the T-line is it's supported right smack dab on the T-line. Now, the major relevancy of that fact is nobody has the T-line on their charts. So it wasn't like everybody was waiting to see what happened when it came back to the T-line, because nobody uses the T-line or the 8 exponential. Or statistically, the number is so minuscule, you just say nobody uses it. But the fact that it's supported right on the T-line is, again, a natural support and resistance level. There's your left-right combo, a strong bullish reversal signal. That tells you the J-hook pattern is probably in progress. There's your J-hook pattern, supporting right off the T-line, breaking out into new territory. IMUX. Whoops. Where did this support? Right smack dab off the T-line, came back up through. What do we got going? Probably wave 3, which will be the same magnitude as wave 1. Oh, I'm pretty sure Wendy probably got it from us when she used to do some speaking in these Thursday night sessions a while back. So yeah, we've shown a lot of people that we do trading of. Sometimes we have different speakers on, like darn. Oh yes, so she uses Fibonacci. What is name of pattern on IMUX? The J-hook pattern. Wave 1, wave 2, wave 3. For all her trend lines, okay. If you're with her group, tell her I said hello. I haven't talked with Wendy in years. There's this is a more specific J-hook pattern. It's called a bobble breakout. Notice how it came up, failed at the 50, pulled right back to the T-line. When it went through, now we're in wave 3. This is an extremely strong probability trend or pattern. And the reason for that is, what's everybody and their brother watching? They're watching to see if they can get through the 200. What are we watching for? We're watching to see what type of pattern's setting up. So we could be buying here knowing that it's breaking out and knowing that everybody else, after they see that it's going to stay above the T line or above the 200, start coming in. And I saw flowers working. There's a J-hook pattern. But I'm trying to think, what holiday? Not Mother's Day, is it? Yeah, did I miss something? All right, and keep an eye on your fry pan bottoms. Look your fry pan bottom breakout on this one. Look where the activity starts. It's when they break out of these patterns. F-slide. Trying to set up a fry pan bottom, which means wave 1, wave 2, going into wave 3. And Futu, fry pan bottom, look where you are. Right smack dab at the breakout. If this opens positive, good probability it's going into wave 3. Now remember, a signal you want to buy when you're in the oversold area. A pattern you're usually going to buy when we're in the breakout area. Did we not do Red Robin? That was one of our fry pan bottoms that you just stay long as long as it stays above the T line. Just have a few more here. SRNE, look where you are on this little J-hook pattern. Right there at the breakout. If this opens positive, what can you assume? Oh, wave 3 is going to be the same magnitude as wave 1. PS, look where this kind of broke out today. I think that, yeah, I thought that was, no, I'm out of fry pan bottoms. That was just a good breakout. Kind of on a double doji sandwich breakout. T-Docs, left-right combo. Look where it is. If this opens positive, you're in the next wave. Oh, on Red Robin, you can still buy this one. It's probably a little bit early, but the fact that probably the breakout level is right around here, or the 50, still says that if it comes up to that level, that's still about a 30% return, so that's worthwhile. Oh, that, Jim, I didn't even think of that. OSMT, there's a morning star signal right here in the oversold area at the 200, closed at the T-line. What's the entry strategy? If this opens positive, what's it doing? It's confirming your morning star signal, and it's telling you the T-line is not acting as resistance. Where's your first likely target? Up here to the 50, which is at least a 10% return away. Again, hold on to your individual stock requests until I tell Jim to do the double line. And FRPX, there's your morning star signal at the 50, closing right on the T-line. If it opens positive, there's another one that's got good upside potential. Would you use drops before T-line for long put spreads? Would you use drops? I don't know what that means at all. Would you use drops would you use drops below the T-line for long? Yes. Works just as effectively Nicola, look at the failure of the T-line. You could have been putting puts on in here with it failing. DVAX was a evening star signal followed by a double. You were putting puts on right here. The candlestick signals, they work just as effectively to the downside as the long side. What was our other one? Zixi was a good. There's your bearish engulfing. And then your doji gap down. What's the criteria for this one? You stay short until you see a candlestick buy signal and a close above the T-line. Or you're in the oversold area, you're starting to see a little bit of buying. You get ready to start taking profits if it starts showing too much strength down in this area. I think the Qs were trading positive after hours. If they open this positive, you can see what's happening to the NASDAQ. It's not backing off. It's still in a slow uptrend. Connie, wait until Jim does the double. And the Dow, if it opens positive after your hammer signal, if they can do kind of a Morningstar type signal again over here, it implies that the market's not backing off. Even though the Dow is the weakest of the indexes, it's telling us this market's not really selling off. Okay, so with that, is there any general questions on candlesticks? To help you see J-hook pattern, wave 2 should be an ABC. You can call it an ABC. We just happen to call it a J-hook because it looks like a J-hook. I can't remember which ones we were. Oh, yes, I can. Let's see, something more defining. Well, yeah, J-hook is wave 1. That's a prerequisite for a J-hook. Strong price move and a pullback, and then there's your J-hook heading back up. What candlestick signal pattern would you look for to do a bull put spread? A bull put spread. A bull put spread. What is a bull put spread? You mean to put on to sell a put spread? Jojo, that if you're thinking bullish or a credit spread, yeah, that's a whole different, that's a whole session. You just decide whether you want to put on a bull call spread, or if it's more, if the price move isn't going to be as big as you expect, you're probably better off putting or selling a put spread. When do you get out before a stock closes below the T? If the criteria for the T line is you stay long as you don't see a sell signal and a close below the T line, and the caveat is if you're starting to move too far away from the T line, then, I mean, that's the criteria. Where do most people buy? They buy exuberantly at the top. How can we tell exuberance? They start gapping up. We're up here in the overbought area. They gap up, start moving away from the T line. They gap up again. and they way up here. So when you're up here, where are you to the T-line? You're way far away. So what's the strategy? You go to your 10-minute chart and see when it starts coming back down through the 10-minute T-line. Same scenario right here. Opens and trades up here. You got two strategies. You go to the 10-minute chart and take profits, or if you're in the overbought area, that far away from the T-line, and they gap it up, again, that's a sign of exuberance. The Japanese rice traders have very simple common sense. If it gaps up and trades up, you put your stop right here where it opened. Logic says if it comes down through there, it's going to create some sort of sell signal. Okay. I guess with that, Jim, go ahead and do the double line. And in 3.8 seconds, do the next double line. All right, Connie, you were doing BLMN. That's a fry pan bottom. You just stay long. XLU. You just stay long. Look for a bobble breakout. Came up, failed, pulled back. You can, if you're long, stay long. If you want to buy, you wait for it to come up through the 200. CZZ, nice breakout, J-hook pattern. You stay long on this until you see a sell signal. ERII, you stay long as this stays above the T. Line. You want to see this get through the 200. Is it smart to buy Apple before the split? Ooh, Cindy, I don't know. You buy Apple based upon the chart. And the chart is going to tell you what people think about the split. So you buy it based on nothing there. The fact that they gapped it up and brought it back down to the T-line tells you don't have a very strong chart on this. I'd be someplace else. TMHC isn't as strong as the other home builders. This one has to open positive and trade positive if you're long. If it opens lower, close it out. MOH is still a nice fry pan bottom in the home builders. Tupperware. This one had your breakout. This is called the T-line crunch. Notice how the T-line crunched the price right up through the resistance level. After that, you stayed long. Now you stay long, but at this point, after gapping up, you're looking for a 45 degree. I'd put a safety stop if I was long. You would have covered the short today on the bullish morning star signal. I wouldn't be going long, though, until they can get it back up above the T-line. And VFF. Fry pan bottom, you stay long as this stays above the T-line. And CLBS, morning star signal. Observe the obvious. They bounce this right smack dab off the 50. Get a morning star signal. You can be buying this one if it opens positive tomorrow. Lattice. Nothing wildly exciting. If you're long, you can stay long. Just don't let it close back below the T-line, because you've got a potential sell signal, a potential sell signal. It's slow uptrend, so your last criteria is it has to stay above the T-line. Apache bounced up apparently off somebody's upgrade. So if you're still long or if you went long, use today's low as your stop. It should be moving in this direction. And BGS, all you can do here is stay long. Matador, this one probably you should have closed out today. Notice how it gapped down below the previous day's low. Right now there's no reason to be in this stock. I'd be someplace else. D-Dog, another one you can buy or stay long. Look at your kind of your Morningstar signal, kind of a McMuffin, followed by a doji sandwich. You can be buying this one with your first expectation coming back up to test the 100. Another one you can be buying, doji sandwich, bullish confirmation. ATVI. Nothing wildly exciting. As long as it stays above the T line, you can stay long. I'd be more apt to be a buyer if it comes up through that level, which means if it starts trading positive tomorrow. AEO, nothing great here. Today's selling resistance at the 50. It has to open positive and trade positive with some quick force to want to stay in this one. Because you can see that it failed at the 50, which is also failing at this downtrend. So that was a long answer to say I'd probably be somewhere else. Meaning there's better charts out there. eBay, when do they report earnings? Right now, they probably wouldn't be, obviously it wouldn't be long. If I was short, it looks like it's trying to support at the 34. If it opened positive tomorrow, I'd close out short positions, but I wouldn't be going long until it closes up above the T line. eBay, that one you can still be buying. Looks like start of wave 3. Did I do Etsy? Yep, that's a good chart. I'm going backwards here. USDP. That's a nice little fry pan bottom. Just make sure you got a lot of volume on a $3 stock. SRNE, I think we did. That one you can be buying if it opens positive. Crocs. Another one that looks like it's breaking out. Yep, breaking out, but it traded back down. That's not your best looking chart. I say that because there's so many others that are much more identifiable as good chart setups. Prego with a bearish kicker signal, you can. That's more of a short position. This is South Korean. All you can do here is stay long, as long as it stays above the T line. LRCX. J-hook pattern. Now what can usually happen, you can see how the J-hook pattern continued this uptrend. Now a Morningstar J-hook pattern setup. What can happen is this would be your trajectory here, and then this could be your trajectory coming out of that J-hook. It improves investor sentiment or confidence. Yelp, you can be buying this one on positive trading. Definitely want to see it break out through the top of this channel. And Rocky. Here's a perfect example of how do you tell whether you're going to be in a 45 degree. Usually a 45-degree will open up right about in this level, hover around, maybe trade positive. If you've got a big price move like this and you've held on to it, if it opens lower and starts trading lower, close out the position immediately. Worst case scenario will be that there's profit taking. You can always buy it back when it comes back up through this level. But the probabilities are 90% or greater that if it opens lower and trades lower, it's going to be a while before they get back up to this level. Nothing here. You need to see some strength getting out through this level. You do have a potential scoop type pattern, but there's nothing on this chart that would get me real excited. ETM, nothing. Can't find a thing. I'd be someplace else. FT, when we said one at a time, or one per person. NPR. This one better open positive. If it opens lower, you close it out. Kodak, I don't know what to tell you on this one. But we did look at this one today. Somebody asked about it in the chat room. When it opened up here and started trading off, your safety stop should have been at where it closed the night before. So you got a stock that went from $2 to $60 in 2 days. Yeah, this is where you would have gone to your 10-minute chart very quickly. Blink has been our big winner. Coming out of the fry pan bottom in the next wave up. You stay long until you see a sell signal. Now, it traded lower after hours. Now it's trading back up to where it closed. I'd have a safety stop down here that if they have enough selling pressure to bring it down through that level, you want to close out the trade. AUPH, nothing there. If you aren't short, well, if you were short, again, this was look at the whipsaw going on here. Kicker signal, and then it came right back down through the signal that told you the bulls were in control. That's where your stop would have been to be out of this one. If you happen to have gone short, you can stay short. However, you're in the oversold area. You're seeing a left-right combo, doji type days. If I was short, I'd have a safety stop at today's high. It shouldn't come back up through that level. All right, we did eBay. Labu, nothing here yet. If you're short, if this opens positive, which I'm guessing with the markets opening positive, if it opens positive tomorrow, you definitely want to cover your short because now you've got a piercing signal. Oh, you said that. This is a good piercing signal. Buy tomorrow. If you're buying on positive trading, you just have to watch to see what happens when you get to the T-line. Remember, that's your so if you're buying, just be conscious of what might happen once you get, or see what happens once it does get to the T-line. Look at all your dojis down here. And where do most people sell? They panic sell at the bottom. Then there's your hammer, your doji inverted hammer, then your left-right combo. Look what happened after all this indecisive trading. Where did things turn around? After the left-right combo. You can stay long, but obviously you want to see it break through the 50, which is kind of breaking this resistance level. If they do, then logically the 200 is your next target. Run, there's your perfect time to have closed out a trade. You had a hanging man Harami. They took it back up, but then they started selling it off. You definitely should have been out on a lower open yesterday. right now you can pretty much go short if this starts showing weakness from here. PG, that's as active as Procter & Gamble has probably been in years. But yes, they've gapped it up in the overbought condition. You can stay long. You can put a safety stop at today's open or at least at today's low. If it continues higher, good. If it comes back down through there, that's, again, where that gap up in the overbought condition is telling you that's where the exuberance has come in. Roku, absolutely nothing. Would not be long or short. Did we do CLBS? I think we did. Morning star signal. BOT, MBOT. Morning star type signal breakout. Yeah, kind of look for your 45 degree off of there. Operations out of sequence. Intel, if you like it, you can buy it. Intel is one of these institutional traders that don't move with any great volatility. You can be buying it. It's just not one of your most dynamic charts. All right, a few more. Cheesecake. That's a toughie, but you're in a fry pan bottom, so there's one basic rule to stay in a fry pan bottom. You stay long as it stays above the T line. APT app, that shooting star signal is a little bit of a warning. If you're long, it has to open positive and stay positive. I would have a safety stop below today's low. If it comes down through there, your shooting star has told you what's going on. Anytime you see that signal, there was that shooting star and caper. This was working very well. But there was your sell signal. We closed it out when it closed back here because you were in an overbought area with a shooting star. You definitely should not be in this one anymore. And I think we did eBay, didn't we? eBay, if it opens positive, you shouldn't be short, but you wouldn't be going long until it closes up above the T line. Starbucks. That's not anything to get excited about unless they've reported something after hours. Starbucks has just always been a junky chart to trade. Do you use a 10-minute chart or any? Yes. If I'm trading something intraday, I usually trade commodities during the day. So today I was trading soybeans off the 10-minute chart. So I went short, covered the short right here, and when it closed up above the T-line, went long. And as long as it stayed above the T-line, stayed long. So closed it out on the close. Well, let's see, that's probably after hours. Where was the close? The close was somewhere right in, probably somewhere right in here. So this is a 10-minute chart. Looks just like a regular daily chart or monthly chart or 5-minute chart. Same criteria. Trying to think of what else. Oh, did trade lean hogs. I missed it here. So I think I went short here as it was it breaking down through this level, but then immediately did a morning star signal, oversold area, so I covered it. But had I seen this kind of rolling over, that's the type of 10-minute chart setups you want to do intraday. Maxar, you can buy this one. Notice your support here at the 34. That one you can buy. NXGN, you stay long with the anticipation that you're at least coming up here to the 200-day moving average. And VGR, that's not quite a McMuffin, but it's a left-right combo after some bottoming action. So you can see where it's going down here. You're starting to see buying. That is not a buy signal. That's just buying. That becomes more of a buy signal. That becomes more of a buy signal. Your stochastic's coming up. This one you can be buying on positive trading, telling you the T-line's not acting as resistance anymore. Neighbor, you stay long, but you can see it's running into a little bit of problem here, but it's staying above the T-line in the 50. So you got doji, doji, doji. Your sell stop is down below today's low. If it comes back in that direction, you want to be closing it out and go someplace else. There's your fry pan bottom. You just stay long on this one. Let's see, I think we did into it. Maybe not. Yeah. Institutional trader sideways. LVGO, we've made a lot of money with this one. There's your little J-hook pattern, breakout. How long do you stay with this one? As long as you don't see a sell signal and a close back below the T-line. You've got two different criteria for getting into a fry pan bottom. If you can figure that this is probably the breakout area, and you're buying right here, look at kind of your bobble breakout, your T-line crunch, you can be buying here, and then you stay long. But your criteria would be, if I'm buying here, to get to the breakout area right here, is that a big enough percentage move to make it a good risk reward? If this is only 4%, you might leave it alone until it does break out. If it's a 22% return just to get up to the breakout area, yeah, you can buy that. So you can make a decision based upon if this right here is telling you you're starting to move back up after this T-line crunch, yeah, you can start buying in here. Silver was acting stronger than gold, but notice what happened after it gapped up. Little hanging man didn't sell off. Long-legged doji selling off. Now, if it trades back below the T-line, you want to close out silver and some of the silver stocks. Schwab, if you're short, you stay short. Pfizer, if you're long, stay long as it stays above the T-line. Square, wouldn't be a buyer yet because there's not very decisive trading, but you can see the resistance level. I'd put a buy stop just above today's high because if it comes up through there, it's breaking out into your wave 3. Roku we did. Oh, FT, I know. Let's see. Is this a symbol, LDL, or is this laughing dull loud? This one's not, well, it consolidated nicely. It stayed above the T-line. Don't let it close back below the T-line. BNDX, this one you should, if you were short because of the bearish kicker signal, you can stay short, but if it opens positive tomorrow, I'd close out the position. Wouldn't be a very strong short, and I wouldn't be buying until you do see a close above the T-line. Shill, nothing. If I had been short, I would have covered the short right in here, but I wouldn't be going long, so I wouldn't be long or short this one. And CrowdStrike. That's kind of your McMuffin. You stay long, or you can even be a buyer if it comes up through this level. That tells you you're still continuing that McMuffin pattern. Let's see, DVAX had been a short, but we could see where the logical place was to start taking profits. As soon as it hit the 50 and you're down here in the oversold area, that was a good place to say, all right, the probabilities are going against me. Maybe I would have closed out half the position. Now you get ready to close out the position on the short side if it opens positive. But I wouldn't be buying it until they can get it back up above the T-line. And AZN, I always thought that was AutoZone, but it's AstraZeneca. This one you can be buying on the J-hook pattern. If you're buying this one on positive trading, use the T-line as your stop. Disney, nothing. If you're short, you can stay short, but I wouldn't even be short because the movement isn't all that compelling. Just not a chart that you want to be trading right now. And PEIX, you can stay long. Look at your fry pan bottom. What do you expect coming out of a fry pan bottom? There it is. Now where are you? Look how far away you've moved from the T-line. Here's where you would use your 10-minute chart. Up here, I would have closed it out right as it came down through this level. That was an hour before the close. Now, you definitely get ready to close it out if they start trading lower tomorrow. Why? Because look how far away you are from the T-line. Look where they gapped it up. Get ready to take some profits. That's just a function of human nature. When they get that big or that big a move, that's where somebody's going to start taking profit. Why is VGR not McMuffining? Because this isn't quite a doji sandwich. This is not, this may be a morning star signal, but remember where a morning star signal has to close, above the halfway point of this candle. It didn't quite get there. And where do you want to see a McMuffin open? Usually above the or at or above the doji. Now, that doesn't mean it's not a good signal, because now it's a potential reversal, not quite a morning star, but now you have a left-right combo. So the terminology doesn't have to be that it's a McMuffin. It's bottoming, same level at the bottom, and a left-right combo, which is a good signal. Chegg, yes, that's your bullish flutter kicker right at the breakout. That's a J-hook pattern on AAWW. That's a decent looking chart. And notice what happened. When you broke out, here's your 45 degree. When did you take profits? Right here. When can you be buying back? You can be buying back right now, especially on positive trading, because now you're in a J-hook pattern with more upside. And I'm going to write that one down. That one a good looking chart. Okay, whoops, I've kept you way past your bedtimes. We got any more? Now, let's see. Last two. WTRH. Stay long on that J-hook pattern. And PBPB. Well, this one's got the fry pan bottom, and there you got the same scenario. Look how far away. So you got to be a little bit more attentive now for selling, because you're that far away from the T-line. You can still expect more upside. Bah. Let's make it even smaller. Well, well, well. I made it too small. You broke out through, well, yeah, so I would expect more upside because you just broke out of the fry pan bottom. You're just above the 200, so I'd stay long as it stays above the 200. Okay. It's almost tomorrow. Okay, everybody. Thank you for showing up. We'll see you bright and early in the chat rooms tomorrow. We'll see you then.